Hey, how's it going, guys? Welcome back to the Module 2 of Technical Analysis Foundation, the complete professional trading course for beginners. Module 2 is all about chart rating basis. In this tutorial, we will go through the sub-module 2.4, talk about the moving averages, and then also on how you can use moving average more effectively to help you find those profitable trade setups. Alright, let's get started. If you are completely new to technical analysis, you probably have seen some charts like this somewhere before and ask yourself, what are those lines moving along with the price bars? These are the moving average lines, which is widely used by many of the professional traders, especially the trend following traders. So I'm going to explain more in this tutorial. So what exactly is a moving average? A moving average is nothing more than a constantly updated average price line that smooths out price movements for traders to visualize price changes and trends in this market. It's considered one of the most commonly used tools for technical analysis. The average value is calculated over a specific period of time, for example, 20 days, 40 weeks, or any time period according to each trader's personal preferences, trading styles, and strategies. Each period of moving average can potentially represent a certain psychological level in the market. This is very important. I'm going to show you more. For example, 5-day moving average represents a strong momentum. 10-day moving average represents a short-term trend is confirmed. 20-day moving average, it shows that the short-term trend pullback support level is around 20-day moving average. And 50-day moving average are commonly considered as an uptrend defense line. And finally, the 200-day moving average. This is where every trader is watching. It's considered the bull market's last stand in the uptrend. So there are two types of moving averages, simple moving average and exponential moving average. The key difference between these two is the calculation formula behind it. Simple moving average calculation is rather simple. For example, a 20-day simple moving average is simply calculated by adding up the past 20 most recent daily closing prices and divided by 20 to create a new average value for each day. Exponential moving average calculation is more complex. It applies more calculation weighting to the more recent prices so that the results are more sensitive to the short-term or more recent price changes. So how can we decide which one to use? Well, exponential moving average moves much faster and changes its directions earlier than the simple moving average. In other words, exponential moving average is more sensitive to the recent price changes than the simple moving average. If you wish to react faster to the price changes, use exponential moving average. For example, for those short period moving averages like a 5-day moving average, 10-day or 20-day moving averages, it's better to use exponential moving average. But using exponential moving averages also means that you are more vulnerable to the high volatility market and easier to be shaken out of your position too early. If you wish to keep in certain trades longer when there is a potential short-term high volatility in the market, you can use simple moving average. Normally, traders use simple moving averages for longer periods, like 100-day simple moving average or 200-day simple moving averages. So the next question is, why do we use moving averages for technical analysis? Well, there are three key areas in technical analysis where moving averages can really help us more effectively. First, we can use moving average to easily identify trends in the market. Moving average is a fantastic tool to identify an uptrend or a downtrend in any market if there is a trend. So here's an example. Daily chart of a market is actually Nasdaq, and as you can see, the price is in a clear uptrend. Then how can we use a moving average to define this uptrend? Well, we can compare 4 moving averages. As a rule of thumb, when the 20-day moving average is above 50-day moving average, and the 50-day moving average above 100-day moving average, and the 100-day moving average above 200-day moving average, then we consider this market is in a healthy, sustainable uptrend. On the other hand, here's an example of a downtrend daily chart. So it's exactly the same we compare exactly the same 4 moving average, but it's the other way around. So which means when the 20-day moving average below the 50-day moving average, 50-day is below the 100-day moving average, and 100-day moving average is below the 200-day moving average, then we consider this market is in a confirmed and strong downtrend. All right, so the second thing that we can do with moving averages is to find the support and the resistance levels in the market. One of the key reasons moving average works very well is because a good amount of traders are all using them and constantly looking at them, which means at some certain moving average levels, there will be a bigger cluster of buyers and sellers waiting there and creating a sudden imbalance between buying and selling pressure in the market. So which means there will be a lot of price actions, buying and selling activities around that moving average levels. And one thing to remember is that you have to stick to the most commonly used moving averages to get the best result. Moving average work well only when a lot of traders see and act on the same level. So go with the crowds and only use the common moving averages like we mentioned before, 20-day, 50-day, 100-day, 200 days. Then the third reason why traders use moving averages is to help them design trading system. Many established trading systems among top traders in the world including moving averages as one of their indicators to generate the trading signals. So how to choose the right moving average period? Choosing moving average period is mainly depends on two things, trading strategy and the trading style. A good way to measure it is how many times per day or per week, per year do you need a meaningful information from the market? Normally, traders do not use just one moving average line. They usually use multiple moving average lines combined together with different time periods. Here are some of the most common moving average periods combinations for different types of traders. For example, day traders, one of the common combination is called the 5-8-13 bar simple moving average. For swing traders, it's 10, 20, 50, 100, and 200 day moving averages. There's one thing I want to highlight here is that for 10 and 20-day moving average, we use exponential moving average to put more focus on the price changes in the short term. And for the rest, we use simple moving average. For position traders, the common combination is 5-day and 200-day simple moving average. Many traders, especially in the algo trading area, like to use Fibonacci numbers to define their moving average periods. Alright, after we get to know what is a moving average and how it works, now let's take a look at how we can apply moving average into our trading. Here's one of the most classic moving average trading strategy. It's called the golden cross and the death cross. The word cross refers to two moving averages crossing each other. And normally we use 50-day moving average and 200-day moving average in this strategy. 50-day moving average and the 200-day moving average are the two most common moving averages a lot of traders are watching. This cross can potentially create a significant imbalance between buying and selling pressure in the market, and even a significant trend shift. So what is this golden cross? A golden cross occurs when the 50-day moving average cross and rise above 200-day moving average. It's considered a bullish sign. On the other hand, a death cross occurs when the 50-day moving average cross and drop below the 200-day moving average. When that happens, it is considered a bearish sign. Nowadays, most traders use the golden cross and the death cross more like a filter to help them narrow down the field of potential tradable markets for further price action analysis. Let's take a look at an example. So here's an example on how you can use golden cross and the death cross to trade Bitcoin. This is a daily chart of Bitcoin way back to 2014. On August 27, 2014, the death cross occurred at $555.2, so which means on that day, the 50-day moving average crossed the 200-day moving average and closed below that, so which means it's closed down. That's called a death cross. Since that, the market went all the way down to I think it's around $260. So that's equivalent to 52.5% drawdown on Bitcoin. And the golden cross occurred at $263.8 on November 1st, 2015. So it's around 1.5 years later. Since that, the market starts going up, and we all know it turns out to be the greatest Bitcoin bull run in our history. Alright guys, I'm going to show you the live demo of the Bitcoin chart on TradingView. Alright, so as you can see, here's the Bitcoin chart on the daily chart. So what we're going to do is that we're going to look for moving average crossovers. And the blue line represents the 50-day moving average 50-day moving average, and the red line is the 200-day moving average. So what we're gonna do is that, remember the example I just showed you in the tutorial, and then right now I'm gonna show you in the live chart. All right. So as you can see, the death crossover happened as it was on the around August 26, 27, around this time. So the 50-day moving average crossed and then closed below the 200-day moving average around here. So around this area, this is the time for you to look for short trade setup. So you bet against the Bitcoin. So once you enter the short trade setup, as you can see, the market just keep crushing, Bitcoin keep crushing, and your short position will end up with quite a lot of profits until you see. All right, so here's one of the things I would like to highlight. Even though the 50-day moving average touches the 200-day moving average, however, it didn't cross and close above it, so it doesn't count as a crossover. So what you do is you just wait, and until around this area. As you can see, 50-day moving average crossed the 200-day moving average and stay above. All right, this shows that the Bitcoin, this market, potentially start trending up. As you can see, the volume goes up, and then the price just jump. So this is the time you should close your short position and start adding your long position, or start putting your long position, because this is the great probability potential that the Bitcoin will start its bull run. All right, so let's see if we're correct. As you can see, go, and the Bitcoin all the way went from $200 all the way up. As long as the 50-day moving average stay above the 200-day moving average, you just hold your long positions and all the way up to here. All right, so just now we say it's around $250 all the way up to 8,900. It's about $9,000. All right, it's about $9,000. That's almost about 400% profit. So a lot of people ask, so when you hold a long position, when do you know it is the top? So when can I sell at exactly like the top? So the things I always recommend to the new traders are, never try to pick the bottom and pick the top. Always trust your system. So then here, what is your system? The system tells you whenever 50-day moving average cross and below the 200-day moving average, the death cross happened, you short. Whenever the 50-day moving average cross and stay above the 200-day moving average, you stay long. Cover your short and you stay long. You take the profit from your short and then you enter your long position. That's your system, very simple. And then if we look back, we know that here is the top. But because right here, the 50-day moving average above the 200-day moving average, we never know if this is the truly top or not. So we do not close our position around here because we don't know if that was the top. How we know we can exit our position? It's right here. It's when the 50-day moving average cross and stay below the 200-day moving average. So this is the system tell us to do. So a lot of people say, oh, well, the Bitcoin all the way went up to $20,000. If I didn't sell over there, then I lost quite a lot of profits. However, this is what trading is all about. You will never know where's the bottom, where's the top. Always follow your system. When your system tells you to sell at the death cross, and you sell at the death cross, which is around $9,000 this area, which is not bad a return. So I hope you guys understand the golden cross and death cross trading strategy. All right, so let's move on. All right, now I will share with you guys some useful tips and the rules on trading moving average crossovers. So I will use golden cross as a main example. For the death cross, it will be just a reverse version of the golden cross. First, rule of thumb to remember. When a new uptrend begins, the 50-day moving average must cross and stay above the 200-day moving average. After the golden cross happens, which means the 50-day moving average cross above the 200-day moving average, only look for potential long setups. Be aware of range markets. Golden cross is a trend filter. It doesn't work well in range markets. In fact, you should stay away from using any moving average strategies in a range market. So for the entry point, after the golden cross happens, do not enter your position immediately. Wait until the price forms a new higher high and a higher low after the cross to confirm the new uptrend. Then enter your position at the higher low bounce. For the stop loss, use the trail stop loss. As the market moves up, you have to trail up your stop loss, and this serves two purposes. One, you lock in some of your profits when the market suddenly goes against the trend. Two, give your trade more rooms to achieve the full profit potentials. Then lastly is the exit point. So for the exit point, always remember to compare 2 points in the market. So the first is the 50-day moving average cross below 200-day moving average, that death cross point. And then the second point is where is your trailing stop loss point. So compare with these 2 points, whichever is hit first, then you exit your trade, get out of your trade. All right, now you might ask this question. Does the golden cross really have an edge in the market, or does it really make money? Well, nothing is guaranteed in the market, but we can always go back to our history and see how the golden cross performed in the past. So here are all the golden cross happened in the stock market from 1930 to 2010. We can see all the win rates after the golden cross happened each time in the stock market. If you enter your long position at the golden cross, after 1 month, it will have 60% probability to become a winning trade. After 2 months, 70% probability. After 3 months, 60%. And if you hold longer than 6 months or even 1 year, you will have 65% chances that your trade will become a winning trade. Based on the probability, golden cross strategy does have a statistical edge in the market. In other words, it can help you make money in the market. Alright, so far we have talked a lot about how good a moving average is, but what are the disadvantages of using moving averages? And I'm going to share with you 5 main disadvantages of using moving average that you should pay attention to. First, a moving average shows a consistent change of the price over time. But it doesn't work very well for some certain markets, especially for those markets in the very high volatile and speculative industries. Also, the markets are heavily influenced by the recent events. Second, your one set of moving average combo for one time frame, it may not work very well in another time frame. The market trend can change significantly depends on the time frame. Lower time frames tend to be more volatile. Your moving average combination may indicate an uptrend in the lower time frame, but the market may be in the downtrending market in a higher time frame. Third, choosing between simple moving average and exponential moving average can sometimes create a dramatic different trade setups, and it may create some confusion to the new traders. Next, it's quite difficult to apply moving average to the markets that are trending in ranges. The whipsaws, or we would call it the ups and downs, of moving averages in the ranging market can create some significant drawdowns to your account if you purely depend on using moving average to generate trade signals. The last one you should know is that moving average is one of the most common targets for market manipulators and those stop hunters. So these are the reasons why we also need some other indicators to help us when we use moving averages in our technical analysis, which I will share with you guys more in the next tutorial. One of my favorite traders, the legendary investors William O'Neill, once said, "What seems too high and risky to the majority generally goes higher. and what seems low and cheap generally goes lower. This is the fundamental philosophy behind trend following, and also one of the most challenging mental hurdles to a lot of new traders. Trend following has helped millions of traders around the world, including William O'Neill, create massive wealth. And if you're a trend follower, then moving average can be one of your best friends when you are riding a long, exciting trend. Alright, so we come to the end of this tutorial. Hope you guys enjoying it, and most importantly, hope you guys learn something about moving average. In the next tutorial, Module 2.5, I will share with you guys some powerful indicators that you can immediately apply to your trading. Again, thanks so much for watching, and I will see you guys in the next tutorial. Bye for now.